Hello and welcome to Market Call. I'm Mark Bunting. For the next hour, we have David Burrows on the program, President and Chief Investment Strategist at Barometer Capital Management. He'll take questions on North American large caps. If you want to reach us and have a question for David, do it one of these three ways. Through the toll-free number, the email address, or the Twitter handle, or you can send a video question by using the social media platform of your choice. Tag us in the post or send an email with the clip. Hello, how are you?
I'm great, thanks. How are you?
I'm very well. Now, the last several times you've been on, you're talking about this secular bull market that we're in. Define it for us, describe it.
Okay, so asset classes come into favor and go out of favor. They're always being revalued versus each other. At times it's domestic consumer-led economies, as we believe it is right now, where equities outperform over a period of time as an asset class. In a secular bull market, three things happen. First, you get earnings growth, which we've been getting fairly steady earnings growth. The second thing that happens is that the multiple that investors are prepared to pay of earnings expands as they slowly become more confident. So in 1982, the market traded at 7 times earnings, and by 2000, of course, the S&P was trading, the average company, over 30 times its earnings. And the multiple expanded all the way through that period. In the period from 2000 through 2012, domestic consumer-led economies, equity markets, underperformed. They just traded sideways for 12 years. The multiples contracted all the way through that period, and money left in favor of China and emerging markets, and commodities, and real estate, fixed income. The third thing that happens in a secular bull market is that over time, the correlations, or the degree to which stocks behave the same, tends to fall, because there's always some big driver that causes the bull market. In the 80s and 90s, technology drove the bull market, and the correlation stock to stock went from over 90% in 1991, for instance, to like 24% by 99. In other words, if you got to tech, consumer, and healthcare, which were the natural beneficiaries of technology, you won. Those sectors did great. The rest, there was the have and have-nots. So we are now in a world where energy, we believe, low-priced, plentiful energy is driving a bull market in equities and consumer-led economies. And there's some natural beneficiaries that are doing remarkably well and have very steady leadership. And there's some sectors and markets that are being hurt by that. So commodities are in a bear market. And emerging markets are really in a bear market or underperforming. But the consumer-led economies, and of course the US, 72% driven by a consumer, is leading the world and is very steady, and there's some very clear themes in that market.
And tell us about the sectors that you're favoring.
So the most obvious beneficiary of low energy prices, and we believe that is likely to persist for some time and have for quite a while now, the obvious beneficiary is the consumer. And so, for instance, you see Home Depot today, against what has been a sloppy market over the last few weeks, hitting new highs today. The housing ETFs like XHB and ITB, hitting new highs today. Consumer discretionary as a whole doing remarkably well, things like Starbucks. So that group is one of the leading groups. Of course, very domestically focused healthcare industry in the US is doing very, very well with good demographics and a good consumer. And of course, some spending on behalf of Obama. You've got financials, a lot of the very domestically focused financials in the US doing very, very well. You know, you see on this side of the border in Canada, we're pretty dependent on commodities. Financials really underperforming. So consumer, healthcare, financials, and of course technology, because every company is looking for productivity, and in the US they have lots of cash, so they can spend it. So those are the 4 leading groups, and they've been very consistent. And we're going to get corrections along the way. Seasonally, we're headed into a tough period, but we think that the trend is probably good for quite some time for equities.
And will one of the catalysts for equities be a rotation out of bonds?
Well, you know, we've had a 30-year bull market in bonds. We got to a point in the last year we had 300-year lows in interest rates, and of course everyone's very confident in their bond portfolios. But even small increases in interest rates do a lot of damage to a bond portfolio. We're seeing weakness in high-yield bonds right now, and corporate bonds have been weak performers. So we think that slowly, as people recognize some of those risks, and the Fed's been very clear to signal that rates are going to start moving higher slowly, money will slowly drip from that over-owned asset class, just like stocks were over-owned in 2000, and slowly rotate their way into the asset class that gives you good risk reward, which is large cap equities.
All right, David, that is the overview, and David will start drilling down on your questions on North American large caps right after this.